Your bank has been quietly underpaying you, and I don't think that's fair to you. Not through fees, through silence. Right now, millions of people, a lot of them women and young professionals just like you, are moving their savings into something called a high yield account. And every finance channel out there is rushing to tell you which bank to pick. I'm not going to do that to you. In my years, running finance teams across 3 continents, I've learned that the people who actually build wealth aren't the ones chasing the best rate this week. They're the ones who understand the machine well enough to never need a list again. So that's what I'm giving you today. The real chain of events that made this trend explode. This isn't a new product, by the way. High yield accounts have quietly existed for years. What changed is the gap between what your bank pays you and what's actually possible to earn. And that gap became too large for me to stay quiet about. Here's what we're covering together: why banks suddenly started competing for your money, what that competition actually means for the cash you have sitting idle, why this became a real cultural moment instead of just another finance tip, and the one framework you'll carry with you long after this video ends, one that never goes out of date. Let me show you the mechanism most people never get to see, because nobody ever explained it to them properly, and that always frustrated me. Banks compete for your deposits because deposits are a core part of how they fund their lending. The more they want your cash, the harder they compete on the interest rate they offer you. When the broader interest rate environment holds at an elevated, stable level for an extended stretch, that competition intensifies because banks know these conditions won't last forever, so they push harder right now while it's still worth pushing. And here's the part I really want you to sit with: not all banks compete equally. Traditional banks, the ones with the branches and the decades of brand trust and the customers who've simply never thought to leave, don't need to work hard for you. You already trust them out of habit, not out of comparison. Online banks don't get that luxury. They have to earn your trust with something real. And the simplest way they do that is the rate they pay you. That's the whole story in one sentence. Online banks pay you more because they have to, and traditional banks pay you less because they don't have to. Let's make this concrete without chasing exact numbers, because those shift week to week. And I'd rather give you something that stays true regardless of the headline. A traditional savings account typically pays a rate so low it's almost symbolic, a fraction of a percent. A competitive high yield account can pay several times more, sometimes many multiples more, depending on where the broader rate environment sits at any given moment. Picture two people, each with the same amount sitting in savings for a year. One person's money grows by a few dollars. The other person's money grows by an amount that could genuinely cover groceries for a month, or a flight home, or a real dent in a bill that's been weighing on them. Same starting amount, same effort, because switching accounts takes about 15 minutes of your life. The only difference is which account they chose. That's not a hack. And it's not insider knowledge I'm handing you. It's simply math that most people were never taught to check, and I think that's genuinely unfair to them. This is also exactly why this moment went viral in the first place. And honestly, I love that it did. It didn't start with a bank's marketing department. It started with one person doing the exact math I just walked you through, posting a screenshot of their old balance next to their new one, captioning it with something like, "Wait, why did nobody tell me this?" That post travels fast because it taps into something very specific, not excitement, but a quiet sense of having been let down. People aren't upset that high yield accounts exist. They're upset that their own bank never once mentioned it to them. And that feeling spreads quickly because almost everyone has a savings account sitting somewhere earning next to nothing, and almost nobody checks the rate more than once a year. This was never really a financial literacy trend. It's a noticing trend, people finally seeing something that was true the entire time. I also want you to understand that this isn't permanent, and it isn't new either, because I've watched this cycle play out more than once in my career. Interest rate environments move in cycles. There have been stretches when savings rates were generous and stretches when they dropped to almost nothing for years at a time. The rate available to you today is a reflection of where we sit in that cycle right now, not some fixed law of banking. That distinction matters because it changes how you should think about all of this. This isn't go open this one account and never think about it again. It's understand that this rate is a snapshot of current conditions, and conditions shift when the broader environment shifts. When that happens, the accounts that cut their rates fastest are usually the ones that never had to compete hard for you in the first place, which is exactly why staying attentive to your own rate rather than chasing today's headline number is the real skill I want you to walk away with. So instead of handing you a bank name that could change its rate next month, let me give you something that will actually serve you for years. A framework you can use on any account, at any point in time, in any economic climate. First, confirm the account is insured up to the FDIC limit. This one detail determines whether your money is protected if the institution ever runs into trouble, and it is never negotiable, no matter how attractive the rate looks. Second, check for a lock in period. A high rate attached to money you can't touch for months isn't really a savings account anymore. It's a different financial product wearing a savings account's name. And the entire value of a savings account is that your money stays within reach. Third, compare the current rate against your own existing account, not against a number some video told you 6 months ago. Rates move on their own timeline, independent of any single piece of content. Fourth, watch for minimum balance requirements and fees that could quietly erase the very benefit you're chasing. A high rate on paper means nothing if a monthly fee eats it alive. This four-part check works exactly the same whether rates are sitting at a multi-year high or have come back down. And that's precisely what makes it worth remembering long after any list of names has gone stale. While we're here, let me clear up a few things I see people get confused about often because I care about you actually understanding this, not just following it. First, a high yield savings account is not an investment. It was never going to outperform the stock market over the long run, and it was never meant to. Comparing the two is comparing tools built for entirely different jobs. This one protects money you might need soon. It doesn't grow money you won't touch for decades. That's a separate conversation for another day. Second, moving your money isn't a betrayal of your current bank, and it doesn't require closing a single thing. Most people keep their everyday spending account exactly where it is and simply route their savings elsewhere. You don't need to overhaul your entire financial life to capture this. You need to move one number. Third, and this is the one people skip most often, this only matters for money that's genuinely sitting still. If you're carrying high interest debt, the math will almost always favor paying that down first before you spend energy optimizing where your savings sit. A high yield account solves one specific problem: idle cash earning less than it could. It was never meant to solve every financial problem you have, and I'd never tell you it does. Here's where all of this fits into the bigger picture, because I never want you to mistake a small tactic for a whole strategy. This isn't a strategy on its own, it's one small, low effort adjustment inside a much larger system. Spend with intention, build a real cushion for the unexpected, and make sure that cushion isn't quietly losing value while it waits for you. A high yield account is simply the third piece. It doesn't replace budgeting, it doesn't replace paying down debt. It just makes sure that once you've already done the harder work of actually saving something, that money isn't underperforming while it sits there doing nothing for you. So let's bring it all together. Banks compete harder for your money when the rate environment makes that competition worthwhile, and that creates a real, sometimes significant gap between what different accounts pay you. That gap is what went viral, and it was never a secret, just something people finally noticed. The specific numbers will keep changing, they always do. The framework won't. Confirm your insurance, check for lock in periods, compare against your own current rate, and always watch for fees. That's the entire system, and it holds whether rates are high, low, or somewhere comfortably in between. You don't need to predict where rates go next, and you certainly don't need anyone else's list of best banks. You just need to check one number today, the rate on your current savings account, and decide honestly whether it's actually working for you or simply sitting there. You deserve to know the difference, and now you do. I look forward to your questions in the comments. I read every single one of them. Don't forget to subscribe and turn on notifications. See you in the next video.